What if you could invest with the same confidence as a billionaire? Imagine building a portfolio so resilient, it could generate wealth for decades. Today, we're revealing 3 stocks from Warren Buffett's Berkshire Hathaway portfolio that are screaming buy right now. These aren't random picks, they're dominant companies, each with a unique edge and poised for growth. We'll break down a global EV leader, a hidden internet infrastructure powerhouse, and a timeless consumer giant. I'll show you exactly why Buffett owns them, and why you might want to too. This isn't just another stock video, it's a deep dive into the mind of a master investor, with actionable insights to reshape your financial future. Hit like, share your thoughts in the comments, and subscribe for more investing wisdom. This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. First up, let's talk about BYD, Build Your Dreams, a name that's become synonymous with innovation in electric vehicles and battery technology. The company is trading under the ticker symbol BYDDY. Founded in 1995 in Shenzhen, China, BYD started as a rechargeable battery maker and has since evolved into a global powerhouse, not just in EVs, but across multiple clean energy sectors. Today, BYD is one of the world's largest manufacturers of electric vehicles, and its influence stretches far beyond China's borders. One of the most compelling endorsements for BYD came from none other than Warren Buffett. Through Berkshire Hathaway, Buffett made a bold bet on BYD back in 2008, acquiring a significant stake when the company was still relatively unknown outside of China. This move signaled deep conviction in BYD's future and its leadership, and it's paid off handsomely over the years. So, what sets BYD apart from the competition? The answer lies in its vertical integration. Unlike most automakers, BYD manufactures its own batteries, electric motors, and even semiconductors. This level of control over its supply chain allows BYD to manage costs, ensure quality, and innovate rapidly. In an industry plagued by supply chain disruptions, BYD's self-reliance is a major strategic advantage. This vertical integration gives BYD a durable moat, enabling it to offer affordable electric vehicles to the masses, not just to the luxury segment. While many competitors focus on high-end models, BYD's strategy is to democratize EV ownership, making clean transportation accessible to a broader audience. Their lineup includes everything from compact city cars to family SUVs, all priced competitively. BYD's dominance in China's EV market is unmatched, but the company isn't stopping there. It's rapidly expanding into Europe, Latin America, and Southeast Asia, establishing manufacturing plants and distribution networks to serve these new markets. In Europe, for example, BYD has launched several models and is gaining traction among environmentally conscious consumers. In fact, BYD recently overtook Tesla in global EV sales, a remarkable achievement that highlights the effectiveness of its strategy and execution. While Tesla remains a leader in the premium EV space, BYD's focus on affordability and scale has allowed it to capture a larger share of the global market. But BYD isn't just about cars. The company is a major player in battery technology, supplying batteries for everything from smartphones to grid-scale energy storage systems. Its battery tech powers renewable energy installations around the world, helping utilities store solar and wind energy for use when the sun isn't shining or the wind isn't blowing. With leadership in both electric transportation and energy storage, BYD sits at the intersection of 2 massive growth trends. The company's electric buses, for example, are used in cities across the globe, reducing emissions and improving air quality. Its energy storage solutions are helping to accelerate the transition to a cleaner, more resilient power grid. Berkshire Hathaway's early investment in BYD has multiplied many times over, turning a relatively small bet into a multi-billion-dollar holding. Despite trimming its stake in recent years, Berkshire still holds a significant position, underscoring its continued confidence in BYD's long-term prospects. Of course, no investment is without risks. BYD faces challenges from geopolitical tensions, especially between China and the US, as well as fierce competition from both established automakers and new entrants. However, BYD's technological edge, scale, and diversified product lineup provide a strong buffer against these headwinds. The company's diverse lineup, from compact city cars to luxury sedans and electric buses, reduces risk and maximizes its reach. BYD is able to serve a wide range of customers, from urban commuters to public transit agencies, and even commercial fleets looking to electrify their operations. One of BYD's standout innovations is its blade battery technology. This battery is not only more energy-dense and longer-lasting than traditional lithium-ion batteries, but it's also designed with safety in mind. Rigorous testing has shown the blade battery to be highly resistant to fire and puncture, setting a new industry standard for battery safety and reliability. Financially, BYD is on solid ground. The company has reported consistent revenue growth year after year, with improving margins as it scales production and benefits from economies of scale. Its investments in research and development continue to pay off, driving innovation and keeping BYD ahead of the competition. The global shift to electric vehicles is still in its early stages, and BYD is perfectly positioned to capture a huge share of this multi-trillion-dollar transformation. As governments around the world set ambitious targets for EV adoption and phase out internal combustion engines, demand for BYD's products is only expected to accelerate. Legendary investor Charlie Munger once called BYD's founder 𝗟𝗟𝗏, a combination of Thomas Edison and Jack Welch, high praise for a leader who's both an inventor and a world-class manager. Wang's vision and relentless drive have been instrumental in BYD's rise from a small battery company to a global leader in clean energy. In short, BYD is a rare breed, a growth stock with Buffett-style fundamentals. It combines rapid expansion with a disciplined approach to capital allocation, making it attractive to both growth and value investors. Few companies can claim such a unique blend of innovation, scale, and financial strength. BYD currently holds a market cap of around $270.69 billion, with earnings per share of 15.39 Chinese yuan, and a price-to-earnings ratio of 21.35. In 2024, the company reported revenue of 777.10 billion yuan, alongside a net income of 40.25 billion yuan. Despite these solid financials, the stock is currently trading around $92.25, which is about 141% below its estimated fair value price of $223.05. That gap has certainly caught the attention of investors looking for potential upside. Beyond the numbers, BYD has been making strategic moves globally. In Brazil, the company is preparing to begin local electric vehicle production in response to rising import tariffs, a move that could strengthen its position in Latin America. The new plant is expected to start operations this month, helping BYD cut down on import costs and improve competitiveness in that market. BYD's off-road brand, 𝗟𝗟𝗏, has also started offering significant discounts on its advanced driving systems, an effort that could boost sales and attract new customers. In fact, recent reports show that BYD is now leading in the EV market, even outpacing Tesla in some delivery and revenue metrics. Additionally, BYD is expanding its presence in Europe with a $94 million investment in Hungary, aimed at tripling its electric bus production capacity. This signals confidence in the growing demand for electric public transportation solutions in that region. However, it's not all smooth sailing. Reports have emerged indicating that BYD is slowing production and delaying factory expansion plans in China. The company has reportedly cut production shifts and reduced output capacity by as much as a third, which could weigh on sales in the short term. On top of that, competition in the EV space remains fierce, both in China and internationally. All in all, BYD is navigating a complicated landscape, balancing aggressive international expansion with some clear short-term headwinds. Its ability to manage production risks and maintain its momentum abroad will likely determine its trajectory moving forward in the highly competitive EV market. For long-term investors, BYD offers a unique opportunity to ride the green energy revolution with a proven winner. As the world moves toward a more sustainable future, companies like BYD are set to benefit from powerful tailwinds that could drive growth for decades to come. If you're looking for a company at the forefront of the electric vehicle and clean energy transition, put BYD at the very top of your research list. Its track record, innovation, and global reach make it a compelling candidate for any forward-thinking portfolio. Next up, let's shine a light on VeriSign, ticker symbol VRSN, a company that's quietly become one of the most important players in the digital world. While you may not see their name in the headlines, VeriSign is the silent giant that keeps the internet running smoothly behind the scenes. Their role is so fundamental, most people use their services every day without even realizing it. VeriSign is the exclusive operator of the .com and .net domain registries. That means every time someone registers a new .com or .net website or renews an existing one, VeriSign gets a cut. Think about how many businesses, organizations, and individuals rely on a .com address for their online presence. Each of those transactions, whether it's a new startup launching a site or a global corporation renewing its domain, puts money directly into VeriSign's pocket. This isn't just any business, it's a government-sanctioned monopoly. The US government, through ICANN, has granted VeriSign the exclusive right to manage these crucial domain registries. No other company can compete for this role, creating a deep and nearly unbreachable moat around their business. It's a position of power that's rare in the tech world, and it gives VeriSign a level of security and predictability that's hard to match. The result? Predictable, recurring revenue streams that are the envy of the industry. VeriSign's business model is built on renewals. Most domain owners don't let their web addresses lapse, so the money keeps rolling in year after year. This leads to sky-high profit margins, often exceeding 65%. That's the kind of profitability you usually only see in software or luxury goods, not infrastructure. What's even more impressive is how little VeriSign's costs change. Their infrastructure is already in place, so as the number of domains grows or prices increase, almost all of that extra revenue drops straight to the bottom line. They don't need to build new factories, open new stores, or chase after the latest tech trends. As long as the internet keeps expanding, and it is, globally, their cash flow keeps growing, almost on autopilot. Instead of paying out dividends, VeriSign takes a different approach to rewarding shareholders. They aggressively buy back their own shares, reducing the number of shares outstanding. This makes each remaining share more valuable over time, effectively boosting returns for long-term investors. It's a strategy that signals confidence in their own business and aligns management's interests with those of shareholders. It's no wonder Warren Buffett is a fan. He's always on the lookout for capital-light businesses that generate consistent, reliable cash flow. VeriSign fits that mold perfectly. Even during economic downturns, businesses and individuals are unlikely to let their .com domains expire. For many, a domain name is their digital storefront, their brand, and their identity. That makes VeriSign a defensive, sleep-well-at-night stock, one that can weather storms and keep delivering results. Of course, no investment is without risk. The biggest threat to VeriSign is the possibility of losing their contract with ICANN, the organization that oversees domain names globally. But with a flawless operational track record and a long history of reliable service, the odds of that happening are extremely low. Their relationship with regulators is strong, and their technical expertise is unmatched. While new domain extensions like IOAI and XYZ have popped up in recent years, .com remains the gold standard. It's the most recognized, trusted, and credible domain extension in the world. For businesses looking to build trust with customers, a .com address is still the first choice. That enduring brand power gives VeriSign a unique edge, even as the internet evolves. VeriSign's growth isn't flashy or explosive, but it's steady and reliable. They consistently deliver single-digit revenue growth year after year, as internet usage expands across the globe. From emerging markets coming online to established businesses renewing their domains, the demand for .com addresses continues to rise. It's a global story, and VeriSign is at the center of it. Berkshire Hathaway's investment in VeriSign is classic Buffett, buying a wonderful business at a fair price, with a wide moat and management that's focused on creating value for shareholders. It's the kind of company that doesn't need to reinvent itself every few years. Instead, it quietly compounds wealth in the background, year after year. Now, it's true, the stock isn't cheap. You're paying a premium for quality, stability, and a near-monopoly position in a critical part of the internet's infrastructure. But for many investors, that's a price worth paying. In a world full of uncertainty, businesses like VeriSign offer a rare sense of security. Think of VeriSign as a digital utility. Just like electricity or water, their services are essential, reliable, and nearly impossible to replace. The internet can't function without domain names, and VeriSign is the gatekeeper for the most important ones. That makes their business model almost competition-proof. VeriSign has a market cap of about $27.20 billion, with earnings per share of $8.19 and a price-to-earnings ratio of 35.10. In 2024, the company posted $1.56 billion in revenue, alongside a strong net income of $785.70 million. Investors are closely watching VeriSign as it gears up for its second quarter earnings announcement scheduled for July 24, 2025. This upcoming report could have a significant impact on market sentiment, especially given the company's already strong financial footing. VeriSign's impressive profit margin, currently sitting at 65.62%, underscores its operational efficiency. On top of that, the company offers a shareholder yield of 6.02%, reflecting its focus on returning capital to investors through dividends and share buybacks. Altogether, VeriSign appears to be in solid shape, with positive momentum supported by both strong financials and upcoming catalysts, like its earnings release. Many investors are keeping this stock on their radar as a steady performer within the tech space. If you're looking for stability and predictable growth in your investment portfolio, VeriSign deserves a spot on your radar. It's not the kind of stock that will double overnight, but it's the kind that can quietly build wealth over the long term, compounding returns year after year. It may not grab headlines or spark excitement at cocktail parties, but sometimes, the best investments are the ones that quietly do their job, day in and day out. Boring businesses like VeriSign often turn out to be the most rewarding for patient investors. Behind the scenes, VeriSign powers the internet with quiet efficiency, and in return, it rewards those who stick with it handsomely. It's a testament to the power of patience and the value of owning a piece of the digital world's backbone. So, if you're building a watch list of toll booth businesses, companies that collect a fee every time someone uses their essential service, VeriSign is a textbook example. It's a digital toll booth, collecting small payments from millions of users, day after day. That's why it's a Buffett favorite, and why it just might deserve a place in your portfolio too. Finally, we arrive at the global beverage icon, Coca-Cola, ticker symbol KO. This is a company that needs no introduction, a brand so deeply woven into the fabric of daily life that it's recognized in nearly every country on Earth. When you think of enduring businesses, Coca-Cola is often the first name that comes to mind. With unmatched brand power and a worldwide reach, Coca-Cola stands as the ultimate Buffett stock. Its red and white logo is a symbol of refreshment, happiness, and consistency, seen everywhere from bustling city centers to remote villages. The company's marketing genius has made Coke not just a drink, but a cultural phenomenon. The brand is everywhere, evoking happiness, nostalgia, and a sense of togetherness. This emotional connection gives Coke incredible pricing power, allowing it to maintain strong margins even as costs rise. Whether it's a family picnic, a celebration, or a quiet moment alone, Coca-Cola is there, creating memories and traditions across generations. Their vast distribution network is a marvel of logistics, putting a Coke in nearly every corner of the globe, a moat few can match. From the largest supermarkets to the smallest roadside stalls, Coca-Cola's reach is truly global, ensuring that its products are always within arm's reach of desire. Coca-Cola's business model is capital light and brilliantly efficient. Rather than manufacturing every bottle themselves, they sell concentrate to a network of bottlers, allowing the company to focus on what it does best: marketing, brand building, and product innovation. This approach keeps costs low and returns high. The result? High margins and a steady stream of cash flow, which Coca-Cola has consistently returned to shareholders through dividends and share buybacks. This financial discipline is a hallmark of the company's long-term success. Coca-Cola is a dividend king, boasting over 60 years of consecutive dividend increases. This remarkable track record is a testament to the company's resilience and commitment to rewarding its investors, no matter the economic climate. Through every crisis, recessions, wars, pandemics, that dividend keeps growing. It's a powerful signal of stability and reliability, making Coca-Cola a favorite among income-focused investors and retirees seeking peace of mind. Critics often argue that soda is in decline, and it's true that consumer preferences are shifting. But Coca-Cola has proven its ability to adapt. The company has invested heavily in healthier options, reformulating classics and launching new products to meet changing tastes. Today, Coca-Cola owns more than 200 brands, spanning water, coffee, tea, juice, and sports drinks. This vast portfolio means that whether you're reaching for a bottle of Smart Water, a Costa Coffee, or a Powerade, you're still supporting the Coca-Cola ecosystem. This diversification is key to capturing growth in healthier categories and new markets. As consumers become more health-conscious, Coca-Cola is right there with them, offering choices that fit every lifestyle and preference. Emerging markets offer huge upside as incomes rise and demand for branded drinks grows. In many developing countries, Coca-Cola is often one of the first Western brands people experience, and as these economies expand, so does Coke's opportunity for growth. Warren Buffett famously said he wouldn't trade Coke's leadership for $100 billion. That's how unassailable its position is. Buffett's love for the brand is well known. He drinks several cans a day and has made Coca-Cola one of Berkshire Hathaway's largest and most successful investments. Management has streamlined operations, divested underperforming assets, and doubled down on innovation. From launching new flavors to investing in digital marketing and sustainability, Coca-Cola remains agile and profitable in a rapidly changing world. The stock trades at a premium, but you're buying into a legacy of quality, stability, and a reliable income stream. For many investors, that peace of mind is worth every penny. In good times and bad, people reach for a Coke, making it a true all-weather business. Whether the economy is booming or facing headwinds, Coca-Cola's products remain in demand, providing a cushion against market volatility. Buffett's decades-long investment in Coca-Cola is a masterclass in buy-and-hold compounding. The dividends alone have paid back his original investment many times over, and the stock's steady appreciation has made it a cornerstone of Berkshire's portfolio. Coca-Cola is a bet on a timeless brand, proven adaptability, and a management team that knows how to reward shareholders. Its ability to reinvent itself while staying true to its core is what sets it apart from the competition. With a market cap of roughly $305.49 billion, Coca-Cola reported earnings per share of $2.50 and a price-to-earnings ratio of 28.40. The company generated $47.06 billion in revenue for 2024, along with a net income of $10.63 billion. Investor sentiment around Coca-Cola has been increasingly optimistic. Wall Street analysts have recently shifted their average recommendation on the stock to a buy, with Zacks Investment Research upgrading it to a rank number 2, also signaling a buy rating as of July 1, 2025. Much of this optimism centers around Coca-Cola's reputation as a strong long-term investment. The company has increased its dividend for 63 consecutive years, earning its status as a dividend king. Over the past 4 decades, Coca-Cola has delivered a total return of over 3,260% when dividends are reinvested, making it a favorite among income-focused investors. Coca-Cola also benefits from its massive product portfolio, offering over 200 different beverage products worldwide. This broad reach helps the company stay resilient, even during periods of economic uncertainty. Additionally, Coca-Cola remains committed to community engagement, supporting programs such as Habitat for Humanity home builds. These initiatives not only reinforce its social responsibility, but also strengthen its brand image globally. Overall, Coca-Cola continues to demonstrate stability and long-term appeal, backed by consistent dividends, a diversified product line, and strong brand equity. While it's not immune to broader market swings, it remains a core holding for many investors seeking a mix of stability and income. For those seeking stability, income, and moderate growth, KO remains a top-tier choice. It's a stock that can anchor any portfolio, providing both comfort and compounding over the long haul. In a world of uncertainty, Coca-Cola stands out as the ultimate buy-and-forget stock, a true testament to the power of brand, discipline, and enduring value. There you have it, 3 Buffett-backed stocks, BYD, VeriSign, and Coca-Cola. Each offers a powerful moat, strong financials, and a clear path for future growth. Taken together, these 3 companies, BYD, VeriSign, and Coca-Cola, showcase very different strategies and opportunities in today's market. From aggressive global expansion to steady cash flow and dividends, they each offer unique value propositions for investors watching closely in the months ahead. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. For exclusive stock tips and in-depth analysis, join the Stocks Galore Patreon community. Details below. Which of these Buffett stocks do you think has the most upside? Let me know in the comments. Don't forget to like, share, and subscribe for more investing insights. Thanks for watching, and I'll see you in the next one. Invest smart, invest like a billionaire.